I want to refer to a note from a couple weeks ago. Basically, you said the sell-off looked overdone. You said sell-off appears to have overshot the fundamentals. We continue to expect positive economic data and prospective EPS growth to support S&P rebound to our year-end target of 2850. The resumption of discretionary buybacks should also provide a tailwind. What do you see?
Well, the fundamentals would suggest that business activity is pretty strong. We still, right now, third quarter results have been showing almost 20% earnings growth versus a year ago. And the disconnect between what you've seen, not just in the core results reported thus far, but looking into 2019, is inconsistent with the price action, both in the economic data as well as the inconsistency between the equity market and the data. So let's look at, for example, the sell-off in the S&P 500 that we had in the last week or so has been indicative of an ISM that would be at 52. And the ISM manufacturing index is something in the vicinity of 60. So either the indications from the stock market are more dire than the underlying economy, or else you've had more volatility to the downside than is supported by the underlying fundamentals. That's one example.
Right.
And so as a strategy, the question is, how does one invest in this kind of environment? And basically quality-related stocks are likely to do better. And that is, in fact, what we've seen. In fact, we have a basket of stocks we trade on Bloomberg, which actually looks at companies with characteristics of high quality, less drawdown risk. And that's really what you want to be investing in at this time.
But stocks are always looking forward rather than looking back. And to what extent should we be concerned?
It's like this.
So to what extent, let's throw out a couple. Housing market seems to be softening. Tends to be an indicator there may be problems on the horizon. Are we concerned about that? Also, I would note that although personal spending was really up, business spending is trailing off, which might indicate the CEOs are sort of to draw the purse strings in.
Well, the data would not necessarily support some of those statements. So if we look at the statement of cash flows of 500 companies, companies are investing $90 billion more cash this year than last year. That's $90 billion in capital spending increase. We're looking at almost $1 trillion of spending. So there's plenty of, that's an increase of about 14%.
So why didn't that show up in the business spending numbers we just got on Friday?
Well, if we want to look at the broad economy versus the individual companies in the stock market, they're two different metrics. I mean, they're two different measures of a general broad thrust. But if we look at individual companies, and you're talking about referencing investing in the stock market. So if we look at a data in the market would suggest companies, in fact, are leaning in to invest for growth.
Very fair. But at some point, the companies have to catch up with the economy. The economy drives the ship, ultimately. It's not the companies driving the ship, right?
And that was exactly my point earlier, which is that if you looked at the economic data with an ISM at 60, suggesting that companies are investing or there are indications for both services and manufacturing, that's the economic data. The stock market, where it's trading now, would suggest and imply an ISM of 52, which is, I would argue and submitted to you my earlier remark, is probably not what we're seeing in the underlying economic data. So underlying economic data is showing an economy that is growing but decelerating. And that is obviously a concern. But we've known that for a long time, or not so much we've known that, we have been anticipating that. Portfolio managers, our economists at Goldman Sachs, most of the individuals with whom I'm in conversations are expecting this. And so the unusual volatility to the downside is not supported, if you will, by the underlying economics.